option contract versus buying shares. The same stock move, different money results. Shares pay you per share, meaning if you buy one share and that market move $1, you just made $1. But an option pay you by the contract premium, multiplied by 100. For example, if you were looking at a Tesla stock and you wanted to buy a share and it's trading at $300, you'll pay $300 for one share. And if it moved from $300 to $301, you just made $1. That's why people buy and hold for a long time. They give these shares enough time to grow and compound. But with options, if an option move $1, you're gonna make $100 because you have 100 shares in one contract. So when you buy options, you're not buying shares. You don't own a piece of the company. You're just buying the right to the contract. One share move $1, you make $1. That is correct. When you own one share, if the share goes from $100 to 101, the share gain $1 profit. If it goes to 105, the share gain $5 profit. A profit equals stock move times the shares owned. This is the basic share math that every trader must understand. One share time a $5 move equals $5. In option, you control 100 shares. So if that contract move $5, multiply that 5 by 100, that's $500. That's why a lot of people like to trade options. You can make a certain amount of percentage in one day that stock investors make in a year. But do not get me wrong, buying and holding is good. You're giving yourself time for the market to move in your favor. It's less risky. Buying shares is $1 for $1. If you buy 100 shares at $100, you control $10,000 worth of stock. A $5 move gives you $500 profit before fees because every share gains $5. Like I said, you're looking at Tesla. It's trading at $100. You bought shares. You bought 100 shares. That 100 share will cost you $10,000. After the move, it moved to 105. You gain $5 per share. So you gain a total profit of $500. This is what happens when you buy shares. One option contract controls 100 shares. A standard stock option contract represents 100 shares. This is why options have leverage. You're not buying 100 shares, but the contract price is tied to 100 shares. So to buy option contract, you don't pay what the market is trading at. You pay a premium. If the stock is trading at $100, the premium might be like a little less, you dig? Sometimes it might be more if the market is volatile, yeah. But you'll pay a cheaper price for an option contract than you would for buying shares on the stock market. Let's look at the chart right quick. So this is Tesla. You see right here, Tesla. Tesla is currently trading at 407. If you wanted to buy one share of Tesla, that's what you'll pay because that's where it's currently trading at. If you go up to 108, you made a $1 profit. Now, if you wanted to buy 100 shares of Tesla, you'll multiply that 100 by 407. That's about $40,700. $40,700 to buy 100 shares of Tesla shares. Now, if I go look at my option chain, I wanted to buy option at 407. I have to buy the ask, telling me 470. That could be correct, but the market is closed, so the price will off a little bit. I'm sure it'll be cheaper than that, or it might be that price, 470. That's $4.70. The option chain gonna only quote one share, $4.70. So you have to multiply that by 100. So that's $470. You will pay for 100 shares. $470 sound a lot cheaper than paying $40,700. Now, when you buy shares, you own a piece of the company, a very small piece of the company. But when you buy option contracts, like right here, you don't own a piece of the company. You're just buying the right to control that contract, to buy and sell that contract. And you're doing that for $407 versus paying $40,000 for shares. You dig what I'm saying? If the premium move $1, one contract move $100. This is where option contracts. But option profits is not just a stock move, just the option premium that moved 100 times. If your call goes from $2 to $3, that's a $100 profit per contract. The same stock move, different returns. Buying 100 shares on the market. If you buying at the price of $100, it will cost you $10,000 to buy 100 shares of whatever the underlying asset is. Let's just say Tesla. Profit if the stock moved from 100 to 105. That's a $500 profit. That's a 5% gain. But you had to pay $10,000. In an option contract that contains 100 shares, the premium is $2. So you're just paying $200 because you have to multiply that $2 by 100. So that'll give you $200. That's the cost of this option contract. It also moved 100 to 105, a $500 profit. The same 5%. So you made the same amount of money with less investment with stock options. Now, if you bought 2 contracts, everything doubled. Instead of making 500, you'll make 1,000. If you would have bought 3 contracts, you would have made 1,500. And 3 contracts would have cost you $600 because each contract costs you 2. So 2, 4, 6. You're still paying less than the cost of 100 shares. Now, options can be risky. Just like you can make the money, you also can lose that type of money too. So you gotta be careful. And options do not always move dollar for dollar. The option call may not gain a full dollar when the stock market moves $5. The option move depend heavily on delta. Delta tells you how much the stock option gain value based on the $1 move in the stock market. So you have to look at your delta. You might make less or you might make a little more. You just have to look at your delta. For example, a delta 50 cent delta call may gain about 50 cents when the stock move $1. So every time it move $1, you're gaining 50 cents in value. But keep in mind, the option changes, quote, 1 share. You have 100 shares. So you multiply that 50 cents by 100, that'll be $50. So every time the stock move $1, you're gaining $50. You have to pay attention to the delta. And the same power that you have with options can hurt you fast. With shares, you can usually hold longer. If your plan allow it. With option, time working against you because you have an expiration date on option contracts. If the setup fail or move too slowly, the premium can shrink fast. Buying shares are cleaner for new traders. Shares are simple, they do not expire. If you buy 1 share and it move $5, you made $5. If you buy 100 shares and it move $5, you made $500. It's simple math, no expiration date, but you do need more capital. Options are better when the setup is clean and fast. And if you're an experienced trader, that's why you have to fill out an application with your broker to get approved for option. They want to make sure you know what you're doing because it can be risky. Options are powerful when you have the direction, timing, liquidity, and a clean entry. You can control 100 shares with less capital, but you must respect the contract risk. That is true. That is so true. You have more leverage, cost less cash, and you have more rules. You have to worry about the delta, the time, the spread, the IV, and the expiration. All that matter when you're trading options. And 1 contract, right here, 1 contract can cost much less than 100 shares. I gave y'all that example earlier in this video. Do not think cheap, think control. Shares, $1 move equals $1 per share. Clean, simple, direct ownership. Like I said, you get a piece of the company. In options, a $1 premium move equals $100 per contract. More leverage, more speed, but more rules. So there you have it. That's the difference between buying a share of a stock versus buying a stock option contract. A share basically move $1 for dollar. With option contract, a $1 move, you got to multiply that $1 move by 100 because you control 100 shares. So a $1 move with an option contract is $100. But a $1 move with a share is just a $1 move. This your boy Leo from Stack and Grow Capital. I hope this video was helpful. If it was and you liked the content, please hit that like button, hit that subscribe button, smash that bell notification so you can be notified when I upload my next video. We gonna get busy on this channel, you heard me? Peace.